Welcome to Uncommon Knowledge. I'm Peter Robinson. Joining me today, two colleagues of mine at the Hoover Institution, both economists, Kenn Judd and John Taylor. John Taylor also served for 2.5, 3 years?
4 years.
4 years, essentially the entire first term.
Right.
As Undersecretary of the Treasury for International Affairs in the administration of George W. Bush. How bad is it? Definition of a recession. The economy contracts for 2 successive quarters. In other words, 6 months of negative growth. The last recession took place in 2001 when the dot-com bubble burst. This past January, Goldman Sachs, a serious institution, predicted another recession this year. Goldman cited a spike in the jobless rate, declines in home sales and manufacturing. To quote the research note Goldman issued, the recession is likely to last 2 to 3 quarters with a cumulative decline in GDP of about 0.5%, close quote. A recession this year, Kenn?
Right now, it's hard to say. This economy is stagnant. Now, the other point here is that the definition of recession seems to be evolving.
You'd give this to your students, what I just gave you,
yes,
right? Okay.
Yes, but the last time that the NBER who's
National Bureau of Economic Research,
when their panel on dating business cycles sat down and looked at the 2001 period, 2002, the data there was very murky. The classic definition of 2 quarters drop of GNP was not even, I don't think it was even satisfied. It wasn't even there.
Didn't have 2 quarters.
No.
So that wasn't, even in 2001, the last bump in the economy was not a classic recession.
It was so mild. I mean, it was such a mild downturn.
And I think what tripped him was, in this declaring a recession, is that there was a drop in jobs, unemployment.
All right.
Now, so this whole definition, now this was one of the first times in history, if I remember correctly, that the numbers were mixed and murky.
Right.
And so then this whole definition of what a recession is evolving, and we could be in a similar kind of situation where number of jobs goes up or down, but maybe output doesn't.
Well, what's happened actually for basically the last 25 years, since the early 80s, we've just had 2 recessions, and they've been very mild by historical standards, and 3 long expansions in between. So my feeling is if we are in a downturn, it's quite likely to be mild like the last 2. That's really the world we live in now.
This gets me to my next question. Listen to 2 periods in American history, 1890 to 1945. The economy suffers 3 contractions of 5%, 2 of 10, and 2 of almost 15%. You get an economy subject to convulsions during that period. From 1983 to the present, as you just said, the economy has a long period of smooth, robust expansion interrupted by 2 very mild recessions, and now I've just heard that maybe one of those 2 recessions wasn't even a classic recession at all. So the question is, 1890 to 1945 on the one hand, 1983 to the present on the other, does that tell us that we've gotten better at government interventions? That we understand how markets work better? That we stand back and let them? Why?
It's a good question. Economists have been researching it all over the place. But I feel a lot has to do with monetary policy. Finally getting it right to keep inflation low, keep that boom-bust cycle from coming back like it did. And you don't have to even go back so far, Peter. Just look at the 70s.
Right.
One recession after another, big recessions. It ended in November 1982, just a little more than 25 years ago. And since then, that policy of getting inflation down, and it's also not just the United States. If you look around the world, it's the same kind of thing.
So the critical, I'm trying to remember my history of the 70s. Arthur Burns, chairman of the Fed, there's a big inflation to run up to Richard Nixon's re-election in 1972. So it's such a...
No, there was a lot of money creation running up to the re-election.
Excuse me.
But prices and wages were under control.
We're capped. Okay, excuse me. But Arthur Burns, he didn't inflate, but he printed money.
Printed money, which eventually brought inflation
and then
up.
later,
so,
right? And he and Milton, that caused a serious breach between him and Milton Friedman. And then Volcker, as I recall, Milton Friedman of blessed memory pointed this out to me once: that Volcker only really started Volcker, who is now kind of a saint in the monetary history, only really behaved well after Reagan took office. That in Carter you get a spike of money in the final year, and then he steps on the brakes, and it's unclear only in the early 80s that they've really adopted measured monetary, right?
Reagan gave Volcker tremendous support in getting this inflation rate down. And Carter didn't give that much support. No question. Carter appointed Reagan, so you got to get the facts
Volcker, right.
Appointed Volcker, of course. But you got to get the facts right. But the point is, Reagan supported that effort, and that made all the difference. And it took a lot of courage.
Reagan was willing to take the recession in 1982.
He was willing to support Volcker no matter what to get that inflation down.
All right. So
Volcker, interest rates in the summer of 1980 were quite high.
Yes, they were. And by January of 1981, as I recall, they were in double digits. There were the, anyway, you're talking to somebody who wrote speeches
Volcker
about
did put the brakes on
right.
before Reagan. Somewhat.
Right, no, right, right.
But no, in terms of the strong
But you'd
political
agree
support from Reagan, that was unusual, particularly given the previous experiences with presidents.
Okay, then let's go from how bad is it and what have we learned about dealing with recessions to how are we dealing with the current circumstances? I'll ask you about two gentlemen, Ben Bernanke, the chairman of the Fed, and George W. Bush, who needs no explanation. Let's begin, by the way, you can't turn on the car radio without hearing the phrase subprime crisis, and this is supposedly the subprime crisis that caused the stock market jitters in January. Give us a layman's explanation. What is the subprime crisis?
The banks made a lot of bad loans. And these were starting a few years ago, they started to issue loans with very low down payments, if not even a zero down payment.
For mortgages.
For mortgages, this is mortgages, yeah. And people didn't have to put down the traditional down payment, and also they got a mortgage even though they didn't have enough income to carry it for a long time, so they got in at low interest rates and then with a balloon or an adjustment later. And so now those things are coming back. They've got to be adjusted or got to make the balloon payment, and people can't. And what the other problem? So the other problem was that a lot of these financial institutions that own these things. By the way, neighborhood bank isn't in this business.
The neighborhood bank issues the mortgage, resells it to a bundler who resells it to a big operation in New York, which then sells tranches of it, and so you end up with immensely enormous and complicated instruments.
And the guys at the top, who have these big packages,
right?
They don't know how much bad stuff they had,
right?
And so they got nervous. Everybody got nervous. Credit tightens.
Could I just add, before I want to get to Ben Bernanke, obviously, but could I just ask, isn't this an example of the kind of thing that a socialist would refer to as market failure? A mediocre analyst on Wall Street gets paid $500,000 a year. These people are paid enormous amounts to be able correctly to value these complicated instruments. And now we discover that there's not an institution in New York that understands the risk in its own portfolio because they were buying and selling these complicated instruments. Wow. Isn't that an example of capitalism collapsing?
It makes big mistakes by individuals, and they should be accountable for it. No question about it. That's what we want capitalism, is to make sure people are accountable for the mistakes they make and they learn from it. But I think from a policy perspective, you want to prevent it from spilling over to the whole economy. You don't want to bail out people who have taken risks incorrectly and should be responsible, should be accountable, the financial institutions, the individuals that undertook these risks. But at the same time, you don't want it to spread, and that's where the policy issues come into
All right, so here we come to Ben Bernanke. By mid-January, stocks are tumbling around the world. On Tuesday, January 22nd, the Fed makes an emergency rate cut of 0.75%, 75 basis points. Then in its regularly scheduled meeting on January 30th, the Fed cuts the rates another 0.5%, 50 basis points. You go from 4.25% down to 3% in just over a week. Now, listen to the response to these actions of the president of the European Central Bank and the Wall Street Journal. In public statements, the Journal noted, Jean-Claude Trichet, throwing a little French pronunciation to raise the tone here, quote, came about as close as a member of the Brotherhood ever will to calling out a fellow central banker, Fed Chairman Ben Bernanke. Mr. Trichet thinks the Fed is running dangerous inflation risks by cutting rates too soon in the face of Wall Street pressure, close quote. Did Ben Bernanke get spooked?
I think the rates have come down too low for where we are right now in this cycle. I do. I have a way to think about this. Some people call it
the Taylor rule.
Yeah. And it says rates shouldn't have come down all the way to 3 at this point, as you say, maybe 3.5 or so. And that rule basically says that interest rates should adjust according to what's happened to the economy. So if it's slowing, rates cut, but also depending on what's happening to inflation. So inflation is still there. In fact, it's picked up a little bit. So these rules, guidelines give a balance. And when you look at those together, it does look like it's a little bit more than we need right now. Now, if there is a recession and if there is a greater slowdown, then there can be additional rate cuts. But right now, it's a little too much.
Well,
go ahead.
If liquidity is a particularly important issue right now, which the Taylor rule talks about long-term averages, but in this recession, if liquidity is a big problem, is this lower interest rate then possibly justified by that?
I think liquidity is always a problem in a recession. The advantage of having a guideline is it makes it clear how much you should adjust. And I think it's, even at 3.5, you're taking in some of those liquidity effects already.
Can I ask, I've always understood the Taylor rule in the following way. However, I've understood it this way without checking with the author of the Taylor rule. Milton Friedman made the point over and over and over again that the Fed is constantly mistiming its actions, that it responds too late and pumps too much money into the economy, then it responds too late to inflation and puts on the brakes, so on. And so Milton famously said the Fed should be abolished and replaced with a computer that simply takes the growth rate and adds some small percentage and issues money at that rate. The Taylor rule I've always understood as essentially embracing Milton's insight that the subjective component in the way the Fed operates is much too large, and you really should have a simple, straightforward set of rules. The Taylor rule specifies specific variables, and everybody, the markets would understand the rules.
Absolutely.
Then that's correct, right?
That's a big part of it, Peter. More predictability. You don't surprise the markets. People understand what central banks are doing, and it's not just the Fed, of course. It's the European Central Bank and others.
Let's move from Ben Bernanke to George W. Bush. The President and Congress, as we sit here, appear to be close to a deal for a stimulus package of about $168 billion is the figure in the front pages today. That is to say, a one-time program of tax relief and cash disbursements of about 1% of GDP. Two quotations. The first, President Bush. Quote, "Passing a new growth package is our most pressing economic priority." Close quote. Nowhere in his statement did I find the word stimulus package. He uses the term growth package. Quotation number 2, the Wall Street Journal, quote, "The stimulus won't do much for the economy, but is driving a higher deficit. The price of Mr. Bush's final budget, which of course includes the stimulus package, may well be paid in far higher taxes under the new president next year." Close quote. Who are you with, George W. Bush or the Wall Street Journal? Ken?
Wall Street Journal. I regard the last few weeks as politicians deciding we've got to do something to get this off the table, off the agenda, do something. There's a political demand for it. What they did, they could have done worse things. They could have done better things. For example, I would have...
But this is just political kabuki. It is
Yeah,
meaningless
and
theater.
the magnitude is going to be small. The impact on the economy. For example, these checks, nobody's going to get these checks until, what, July, I think, is what the Treasury Department says, that they're kind of busy with other things until then. And so we're not talking about anything that is
Processing our tax returns, unfortunately.
And it's a one-time check, so it's going to have some impact in the third quarter, maybe leaking into the fourth quarter. I haven't looked at the details. I might not get a check. If I did, I'd just stick it in the checking account and save it. We wouldn't spend it. And even all the economists agree that most people will just do that and not spend it. There's a non-trivial number of people.
So you hear about the stimulus package, and it neither encourages you nor outrages you. You just shrug and yawn and go on with your life.
I would like to have seen more permanent tax rate changes. In 2001, same situation, recession, what do we do? In that case, there was a multi-year tax cut. Marginal rates came down, that lowest bracket from 15 to 10, the top from 39.6 to 35. And I think that did some good. This one doesn't change marginal rates at all. It doesn't. It's just a one-time.
This really is a one-time pop.
Thing, and growth could increase in the third quarter a little bit, but that's
Will you agree with
type
Ken that at least it does very little harm?
What I think it does, quite frankly, is reduces, and I hate to say this, the possibility of avoiding the tax increases coming down the line, and that is the sense of the Wall Street Journal. Yeah. We right now on the books, as it stands now, we have a $150 billion tax increase coming in 2011.
Right.
And that's going to get bigger and bigger unless someone passes a law to change that. I think this dynamic has unfortunately made the likelihood of those tax increases greater. We have to work towards that.
Now,
All right.
what historically has been done sometimes in these situations is put in something, well, in the Kennedy Johnson years, it was the investment tax credit that was put in. That was initially temporary, but then ended up lasting a long time. And that's where businesses who are buying new equipment get an extra tax break.
Right.
And of course, Bush passed something like this called bonus depreciation. I believe it was 2002 and 3. And the logic behind that is that investment spending by firms goes down a lot in a recession,
Right.
because they don't see themselves growing, and so they just don't expand their production capacities, and so they dramatically reduce their spending on equipment, and so the equipment sector shrinks. So there's excess capacity now. Give people tax incentive to buy new equipment, and that helps to avoid that drop in investment and helps to keep the economy
You're saying
going.
that's one of the things that would have been better if they
And making it permanent.
Right.
And that's a very good sort of bang for buck permanent tax
So
change.
you both view this actually as a missed opportunity, at best, really,
Yes.
right? That's the
Yes.
best that can be said for it? All right. Now I want to know, I've got a couple of topics here. I want to know how economists think about topics that are very prominent in the presidential season. The first of these is free trade. Since 1970, real GDP has roughly tripled. During the same period, our trade imbalance, that is the amount by which the goods and services that we purchase from other countries exceeds the goods and services that we sell other countries, has increased by 30,000% or so. And each year our trade imbalance is now about 800 billion, 250 billion of that accounted by a trade imbalance with China alone. What do you do with those data? You shrug them off as unimportant, they give you heartburn, they're meaningless, they're critical. What do you do with that?
The trade deficit's coming down. You know, I think it goes up, it goes down. It's a measure of how much Americans are saving compared to the attractiveness of America as a place to invest. It's attractive to invest more than our savings. That's the trade deficit. And it is beginning to correct right now. I don't think that has anything to do with all the benefits you get from free trade, that increase in productivity, the increase in incomes. Basically, the thriving of the United States as part of the global economy comes from free trade, and the trade deficit is really not
It is not an important number. It's not
also,
a critical.
right, exactly, doesn't affect the unemployment rate has been lower during this period than in the 70s, as we talked about a few minutes ago. So,
Let me quote to you Pat Buchanan, Ken. All right? Quote, "The dollar is plunging, and the dollar is plunging, perhaps maybe too strong a word, but that's been sinking for some months now, because America has been living beyond her means, borrowing $2 billion a day from foreign nations. The dollar has plummeted more in Bush's term than during any comparable period of U.S. history. A sinking dollar means a poorer nation, and a superpower with a sinking currency is a contradiction in terms." Close quote. Unscramble that one.
Exchange rates go up and down. When the euro first came out, it was a bit above $1, then it fell to something like 70 cents, I think, down, and then now the euro is up to $1.50 roughly. There's a lot of fluctuations in exchange rates over time. Why is a good question. It's not something that economists seem to understand very well. There's a lot of volatility in exchange rates. But now this dropping of the value of the dollar is one thing that's then helping to correct the trade deficit. The other thing about the trade deficit to keep in mind is that offsetting some of that deficit is the fact that we have investments abroad and foreigners have investments here. What foreigners do is they put their money in nice, safe banks and get low interest rates, and then we invest in risky projects elsewhere. And over time, the pattern has been that we're making a higher rate of return on our investments overseas than what the foreigners are making here because they like safety. So we have this, and also a lot of the numbers there's undercounting here because a lot of our assets that are abroad are not counted because they're still sitting abroad.
John, let me give you one other statistic. During the last 7 years, the Bush presidency, household debt has almost tripled. You take total household debt and total federal debt, and combine them, and you've got a kind of national indebtedness that's about 168% of GDP. We were talking a moment ago about a stimulus package of 1% of GDP. All right, so that's a lot of indebtedness. Now, there are a couple of ways to think about indebtedness, and I'd like you to tell me which one is correct as applied to the nation. One, I'm broke. I'm using my credit card. I run up a debt that I can't handle. It's going to kill me. The other is I take a mortgage, I buy a house, I pay it off, I go into a heavy indebtedness, but with a good, rational reason, and it all works out in the end. Which of those is closer to applying to the state of the country?
I think it's the latter, quite frankly, because it represents foreigners investing in the United States, and that generates rates of return that effectively can generate that growth. And actually, in terms of the dollar, I think you got to be concerned about the dollar. You know,
do.
The dollar is our currency. You don't want to have it depreciate all the time, and that goes back to the bad old days of inflation. So we want to keep our inflation rate low, which will generate a strong dollar over time. I think that's important.
You do. So Buchanan is on to something there.
On the dollar weakness is something to be concerned about. You just can't just cast it away. It's no big deal, but because it is a deal, you need to be concerned about our currency.
Let's turn to the next president, who's going to have a hard choice to make. Background: George W. Bush increased spending, but cut taxes. Under the next president, spending, I don't know anybody who doesn't expect spending to increase, because as the baby boomers age, they'll claim more and more from government entitlement programs. These are programs that are already enacted, that are in law, that would be virtually impossible to reverse. And as for taxes, the Bush tax cuts, as John said, are set to expire very substantially by the end of 2010. So, what should the next president do? Go ahead and let the Bush tax cuts expire on the theory that the government needs extra revenues to cover the higher spending? Or should he try to make the Bush tax cuts permanent? Kenn, Judd.
Whatever the proposal is by anybody, Obama, Clinton, or McCain, I think it should be consistent. And so the question is not should you make the tax cuts permanent, but if you're going to make them permanent, where are you going to cut spending? Also the other elephant in the room is AMT. McCain also has proposed
minimum tax.
Has also proposed eliminating the AMT, which is another big loss of revenue for the government. So, if Ron Paul was elected president, then yes, make the Bush tax cuts permanent. And
because he would eliminate 1/3
yes.
the federal bureaucracy the next day, or try to.
But McCain is not. McCain wants to increase
What
the
you're
military.
saying effectively is the next president must raise taxes in a massive way, because you're saying you can only cut taxes if you cut spending, and nobody believes that we can cut spending,
Somebody
right?
down the road has to pay the bills. Somebody down the road has to pay the bills, either by cutting spending, cutting benefits, or raising taxes. What's the mix? And you can kick it down the road, but somebody down the road has to do it.
Well, first of all, I think it's very important to make the tax cuts permanent, to prevent the taxes from increasing. It would be really a large drag on the economy. The AMT is getting extended year by year anyway, so why not just deal with that one time and get it off the books? It's very confusing now. It just keeps getting extended. I don't think you need to cut in the sense of you're using it. It's basically slowing down the growth of a lot of these programs. It seems to me it's quite doable, and with the negative reaction so many people have had to the increase in spending, really from 2001 to 2005, it's until this year it's slowed down quite a bit. But I think that's what politicians do, and I think someone like McCain is.
Let me add, here's the absolutely fundamental question, and it requires reflection on the experience of the last quarter century. And I begin by remembering, this is the way I begin most of my economic thoughts, a conversation that I had with Milton Friedman. And Milton started with the position, first of all, what he wanted to do was decrease government spending. That was always the end. And he started with the position that you ought to cut taxes, but only where you can find offsetting cuts in government spending. And he ended with the position that the only way to place pressure on spending was by cutting taxes. I never heard him use the phrase, but he subscribed to the starve the beast thesis, correct? Now, that seemed to me to fit what I saw of experience in the 1980s when Reagan cut taxes, and then there was this, they were worried about climbing deficits, so he clawed back some of the tax cuts in TEFRA, that huge tax. But TEFRA was coupled with a promise by Tip O'Neill and Bob Dole that for every dollar in tax increases, government spending would be cut by $3. And the best studies that I've seen suggest that government spending was cut by at most 30 cents. It didn't work. Even with Reagan, even with a deal, it just didn't. The incentives in Washington are such that it's virtually impossible to cut spending unless you can go to the voters and say, we don't have the money.
But when you think about what works and what doesn't, remember we had revenues growing very strongly. And in fact, by the late 90s, there was a budget surplus.
Right.
We had a recession.
So it worked. The Reagan program effectively worked.
Basically, it worked, yeah.
So you start by cutting taxes. That's the pressure point.
If
Is that
that's
not
what
right?
you can do politically, I think it's important to get the spending cut too. You know, it's very it's much more difficult to work on the spending, in fact, but that's essential. I think it's kind of you do it to both, but right now a tax increase in 2011, 2012, 2013, et cetera, is what's on the books, would be very bad for the economy, and we just make sure we can't do that.
So go ahead. We've got you outnumbered 2-1 now,
1980s
Ken.
and 1990s, this deal seemed to work.
By the way, we should say, Reagan cut taxes, and Clinton left them low. He raised taxes in on the top brackets a little bit. Fundamentally, he left them low. That is a bipartisan consensus effectively had been achieved. Furthermore, Reagan reduced spending as a proportion of gross domestic product, and Clinton reduced it even further. You have a bipartisan achievement, which alas in the current circumstances has slipped some. Spending has gone up a little bit as a proportion of GDP. But it worked. It did work. You cut the taxes.
But then it fell apart in 2001. We had a $3 trillion increase in gross federal debt. We're up to about $9 trillion.
Because
Remember, there was this recession, and recession
which was
always
very mild. I don't think the recession can.
It was mild, but you always have.
I don't think that recession can justify a $3 trillion increase in our national debt today.
It's a good fraction of it, actually. But there was an increase in discretionary spending, and that's the problem. No question about that.
Now,
the
also
Republicans sidled up to the trough and it behaved like porkers. Is that roughly what happened?
Yes.
All right, gentlemen, our fast answer round. Give me one word if you can. One word now. Try hard. The number of illegal immigrants now in the country is about 12 million. 3 years from now, that is, after the next president has had time to enact his program and the program has had some time to begin taking effect, will the number of illegal immigrants in the United States be higher, lower, or about the same? Kenn, Judd.
same.
Lower.
Lower. Our trade imbalance is now about $800 billion a year. 3 years from now, higher, lower, about the same?
Maybe a little lower.
Lower.
Lower, largely because of the dollar adjustment?
More than just a little, yeah.
More than just a little. Federal spending is now about 20% of GDP. 3 years from now, higher, lower, about the same?
Higher.
Really? John?
Hoping for lower.
Hoping for lower.
He did ask for the hopes.
Wait a minute. Hold on. Before we go any further, let's get this. Which president did the most to stimulate growth in the economy of the United States? Ronald Reagan, Bill Clinton, or George W. Bush?
John Kennedy's record was also very good.
I'm
As
not
well
going
as
back
Reagan.
that far. Well, we could begin with George Washington. All right, for your sake, we toss in John Kennedy, who cut taxes.
The Kennedy tax cuts and the Reagan tax cuts were both major.
Did you hear me ask
cuts.
him for a one-word answer? Did you hear me?
I did. That's okay.
So Kennedy, Reagan, Clinton, or George W. Who?
Reagan.
All right.
Yeah, Reagan.
That's easy for both of you.
Yeah, because he just changed the situation so dramatically
All
at the
right.
time, and you could say Bush continued, et cetera, but Reagan.
Which
made the big
candidate would do the most to stimulate growth in the years to come? Barack Obama, Hillary Clinton, or John McCain?
I have no idea.
How can you say such a thing?
Aren't
you supporting Barack Obama? You were limning the beauties of the man to me the other day. I thought, no.
On other grounds.
You, a professional economist, do not bring your expertise to bear on this man in evaluating him?
Yes, but predicting what he does versus what Clinton would do or Bush, it's too much noise. Nobody would have predicted George Bush.
So Bill Clinton was right. Voting for Barack Obama would be a roll of the dice. Kenn, Judd confirms this?
Voting anybody anytime is a roll of the dice.
Which candidate, John?
McCain.
All right. We should make clear that John is advising John McCain. So that answer is not a total surprise. Federal tax receipts now about 18.5% of GDP. 3 years from now, higher, lower, about the same?
I bet it's going to go up.
A lot.
modestly.
I think it could be higher,
You do?
even with the tax cuts we're talking about.
Oh, really? Oh, well, I'm hoping you can find a way to lift the end of the
Remember-
show here, so try to find it. Sure. 3 months from now, will the United States be in a recession or not?
Minor, if at all.
Minor, if at all.
All right. The Fed funds rate is now at 3%, the Dow Jones Industrial Average at about 12,500. At the end of the year, give me a whole number for the Fed funds rate and the nearest 1,000 for the Dow Jones. Ken?
4% for the Fed funds and 12,500 for Dow Jones.
John?
You know, I'm not going to forecast either of those right now.
You're not going to?
I have the Taylor rule on the line with respect to the federal funds rate. People can look it up and see what it is. Remember, it's 1.5 times the inflation rate plus 0.5 times the GDP utilization plus 1.
You know, you are the only person on this show who, during the short answer segment, has ever referred anyone to a program they can run on the internet. You can run the Taylor rule to get the answer.
Yeah.
John Taylor and Kenn Judd, thank you very much.
Thank you.
This has been Uncommon Knowledge. I'm Peter Robinson with the Hoover Institution. Thanks for joining us.